The situation in the Middle East remains volatile, and as a result, so do global energy prices. Oil prices in the 5 months since the conflict began have on average been almost 50% higher than in the months before it, and higher global energy prices will push up on inflation over the coming months. Set against that, the underlying disinflation of the UK economy has continued. Economic activity is subdued and the labour market is soft. There is little as yet to suggest that higher energy prices are becoming embedded in broad-based inflationary pressures in the UK economy, although we cannot draw too much comfort from that at this stage. Today we've kept bank rate at 3.75%. Monetary conditions have tightened for households and businesses since the conflict began. We see that, for example, in higher mortgage rates. And that tightening reflects the underlying economics. In particular, the expected increase in inflation from higher energy prices, which needs to be considered alongside whether the underlying disinflation in the domestic economy will continue. We will monitor the situation carefully and stand ready to adjust our stance as the evidence and our judgments on the outlook evolve. It is our job to ensure that inflation gets back to the 2% target and stays there, and that is what we will do. So I will now set out the outlook for inflation in further detail before turning to the projections and scenarios that have informed the Monetary Policy Committee's decision today. Chart 1, although we seem to have chart 2 in front of us at the moment. Well, chart 1, when it appears, I hope it will, shows how the near-term outlook for inflation has shifted in recent months as events in the Middle East have evolved. 12-month CPI inflation has fallen by 0.7 percentage points since March to 2.6% in the latest data for June. That is 0.4 percentage points, here's chart 1, lower than we expected in April's monetary policy report. Inflation has been lower across a wide range of goods and services, not least food. The underlying disinflation process has been offset by higher energy prices following the conflict in the Middle East. Motor fuel prices are currently contributing 0.6 percentage points. In our latest near-term projection, that's the dashed blue line, higher energy prices push inflation up to a little above 3% by the end of the year. Energy prices remain highly volatile, however. The analysis in today's monetary policy report is based on an average of energy futures prices over the 15 working days up to the 20th of July. And that's shown here in chart 2. Over this period, front-month Brent crude oil futures prices averaged $78 per barrel, which is below the $100 average ahead of the April report, but above the $64 average in the run-up to the February report. Within those 15 working days, the prices ranged from close to $70 a barrel, while a ceasefire was in place, to close to $90 a barrel after it had ended. And in the few days since the cut-off date for our projections, the Brent oil price has spiked to above $100 before falling back to around $84 earlier this week. As of this morning, it had gone back above $90. So these, of course, are all significant moves. And I would add a further word of caution. So-called crack spreads, the difference between the prices of refined petroleum products and Brent crude oil, have risen well above their pre-conflict levels, reflecting a fall in global refining output. And along with gas prices, it is the prices of these refined products rather than the price of crude oil that matter for domestic inflationary pressures. As chart 3 shows, crack spreads have fallen from recent peaks for jet fuel and diesel, but continued to rise for petrol. Given this volatility, the size and duration of the energy price shock is a key uncertainty for the outlook for UK inflation. A second key uncertainty is how the shock will transmit through the UK economy. We can already see the direct effect on the forecourts, and we expect Ofgem's price cap on household utility bills to rise further to around £1,680 in the fourth quarter of this year, though that is about £45 lower than it would have been without the temporary cut to value-added tax on electricity bills announced by the government last week. Over the coming months, we also expect to see the effects on consumer prices from businesses passing some of the higher energy costs they are now facing through the supply chain. Model evidence and intelligence from the bank's agents both suggest that they will build more slowly than we expected in April, but we think these indirect effects will add nearly half a percentage point to inflation over the second half of the year. We have to watch very carefully that these direct and indirect effects do not lead to more persistent inflation through second-round effects on domestic wage and price setting. Repeated inflationary episodes over the past 5 years have made households and businesses more attentive to inflation. Internet searches for inflation terms have spiked following the outbreak of conflict in the Gulf, for example, and remain well above historical norms as shown in Chart 4. And while they have fallen notably from recent peaks, inflation expectations remain elevated. Reassuringly, there are few signs so far that second-round effects are generating more broad-based inflationary pressures. I'll make 3 observations about this. First, the process of underlying disinflation in the UK economy has continued. We can see this in Chart 5. It shows how services inflation fell from 4.5% in March to 3.6% in June, and how underlying services inflation measures have fallen to below 4%. Although still somewhat above estimates of target consistent levels, these falls point to a broader slowing in domestic inflationary pressures. The second observation is that the backdrop of relatively weak household demand reduces the ability of firms to pass through cost increases to consumer prices. As Chart 6 here shows, underlying GDP growth is projected to weaken slightly further in the near term as the effects of the conflict weigh further on demand. Contacts with the bank's agents point to weak demand limiting pass-through of cost increases to prices. Consistent with this, 2/3 of firms in the bank's decision-maker panel are expecting higher energy to result in reduced margins, and firms do not seem to expect to raise prices more than the increase in their costs. The third observation I'll make is that spare capacity in the labour market is likely to reduce workers' ability to secure higher nominal wage growth in response to higher inflation. As Chart 7 shows, private sector regular wage growth eased to 2.9% in 3 months to May, and we expect it to remain around that level throughout the current quarter. Other measures of pay growth remain higher at around 4%, but have fallen gradually over recent months. The bank's agents continue to report average pay settlements of 3.5% for 2026, below the average settlement of 4.0% last year, citing looser labour market conditions. In the 3 months to July, firms in the decision-maker panel expected average wage growth of 3.4% 1 year ahead, a little below expectations before the conflict. But a lack of evidence so far does not rule out that wage and price setting could generate second-round effects in the future, especially if energy prices remain elevated. As firms tend to make wage settlements by the second quarter of the year, for example, the impact on wage growth may only emerge well into next year. So while it is reassuring that indicators of second-round effects remain benign, the overall assessment is necessarily at this stage tentative. And given the uncertainty, monetary policy needs to balance the costs of leaning too little against potential inflationary pressures and the cost of responding too much. How much policy needs to lean against inflation and the level of bank rate needed to achieve that will depend on how the outlook evolves. To inform its policy deliberations and explore the outlook, the MPC has considered a central projection and 2 scenarios. These projections are neither all-encompassing, nor do they reflect the full distribution of risks. But they reflect key sources of continued uncertainty around the future paths of global energy prices and the strength of second-round effects. Chart 8 shows the assumed paths for oil and gas prices in each of these projections. The central projection is conditioned on wholesale energy prices evolving in line with gas and oil futures curves in the 15 working days to the 20th of July. Oil prices peak at just above $100 per barrel before gradually declining to around $71. Gas prices peak at a little over 120 pence per firm before gradually declining to a little under 60 pence. Second-round effects are assumed to be moderate. In the milder scenario, energy prices follow a lower path, calibrated to follow futures curves around the beginning of July, shortly after a ceasefire was announced. There are no new second-round effects in this scenario. It represents a version of the future where a ceasefire agreement is fully implemented and energy price volatility is lower. In the adverse scenario, by contrast, the conflict continues, perhaps in an episodic manner, and with no clear resolution, so that energy prices rise materially above the path in the central projection and remain above it, while inflation expectations drift higher, leading to stronger second-round effects. Chart 9 here shows the paths for inflation and the output gap in the three projections, conditional on the market curve for interest rates based on an average of forward interest rates in the 15 working days to the 20th of July. In the central projection, inflation is projected to fall from its near-term peak over next year as the effects of higher energy prices fade and be slightly under the 2% target in the medium term as energy prices fall back and the direct effects of energy prices turn negative. In the milder scenario, the path for inflation is lower throughout, while inflation rises significantly and persistently in the adverse scenario. These paths illustrate that if the assumptions underlying any particular projection or scenario come to pass, the appropriate stance of policy would likely vary from the market path on which they're conditioned. If the conflict in the Middle East persists for an extended period, for example, and we begin to see signs of emerging second-round effects, it's likely that we will have to tighten policy to counter inflationary pressures in the UK economy. Similarly, if the conflict is credibly resolved in the coming months, the paths would point to a looser policy stance than implied by the market curve. But we do not know how the future will play out, or indeed, if it will play out in a way that resembles any of these projections and scenarios. And that's because the situation in the Middle East is highly uncertain. We have to set policy now, seeing through the day-to-day volatility and weighing all the risks and uncertainties we face. Current market pricing for future interest rates similarly places weight on and averages across a range of outcomes for energy prices and second-round effects. As Chart 10 shows, model-based estimates suggest that the upward slope in the market curve reflects risk premia rather than expectations of future levels of bank rate. Similarly, median expectations in the bank's market participants survey are for bank rate to remain unchanged over the year ahead before declining further out. There's no contradiction in this. Market participants find it most likely that bank rate will remain at its current level throughout this year, while investors quite reasonably require a premium to compensate for the risk that bank rate may have to go up should inflationary pressure from the energy shock prove more persistent. That seems a reasonable position for now. The resulting upward slope in the interest rate curve has directly tightened monetary conditions for businesses and households, including through higher mortgage rates. When it comes to bank rate, the MPC will set monetary policy as appropriate, given the evolution of the economy, balancing all the risks to the outlook for inflation in order to achieve the 2% target sustainably. And it's in that light that a majority of the MPC voted to hold bank rate today at 3.75%. So with that, Dave, Claire and I will be happy to take your questions. Thank you.
Should we do Maureen and then Ed?
Hello, Mehreen Khan from The Times. Governor, for the last couple of months, you've told us that the market's been doing a bit of work for you with financial tightening, and that's given you time to wait and see about the evolution of oil prices. Your colleague at the Fed made some similar comments, but they weren't taken so well because at some point you have to sort of validate where the market is. Are you ready to give them that validation, which is eventually there will be monetary tightening, or actually are you more comfortable if there is, if some of that financial tightening disappears because the conditions in the domestic economy at least would give you breathing space on the opposite side? Well,
I'm not going to comment on the situation in the US. That's obviously for the Federal Reserve and for Kevin Walsh. What I would say is this, and just it really repeats what I just said. I think that the situation we see with the market curve is entirely consistent with our reading of the economy. So, when you say the market's doing the work, I think actually, it's a reflection of the economy. The market is reflecting that. Our views, I think, are consistent with that. It is consistent with the central view in the market that rates will stay unchanged this year, but there is a distribution of risk which puts it on the upside. And one way of illustrating is that these three scenarios that we've got, and particularly the central one. Look, I would I would caution somewhat that the world is so uncertain at the moment that the probabilities you would attach to those scenarios, and particularly the central one, is lower than usual. But if you look at the distribution of those scenarios, you can see the similar pattern. The upside scenario is further from the central scenario than the downside scenarios, and I think that's a reasonable illustration of the economics.
Ed?
Hi, Ed Conway from Sky News. Only kind of 3 months ago, the world felt very scary, and a lot of people expected that the Bank of England at this point was going to be raising interest rates.
Yeah.
I mean, you said a bit about the kind of change in the background that's helped contribute to leaving rates on hold. I just wonder, does the world feel less scary now than it did 3 months ago? And also, what would it take you? What are you looking for to make you actually act?
So, I mean, I'm sure Claire and Dave want to come in on this. Let me kick off briefly. I mean, the world feels, particularly obviously the situation in the Gulf and the Middle East, feels as uncertain and volatile today as it did then. I think it's the right. I mean, you can see that if you compare our upside scenario today to the scenario C it was that we had back in April, you'll see it has a different profile. It's got a lower peak, but it's persistent, and I think that does, for me, that reflects my sort of my thinking, such as it is, about how this conflict plays out, in a sense that we're faced. I do think there are points of resistance in this process. I'm talking sort of broad geopolitical terms now, that set in when oil prices have gone high, particularly well above, when they get above 100. But as we've seen, and I highlighted in the describing the window, the normal window that we've had both the sort of the ceasefire period and the breakdown of the ceasefire period. So, the way I look at the upside scenario today, it's a more persistent, missiles get fired period. We don't know what ends it, because we don't properly understand really what's going on there at the moment. So that's my sort of evolution of my thinking there. Now, I think the last thing I'd say, coming back to what I said earlier, is, however, I do think that we've seen more evidence that indicates that the disinflation process is in place. CPI is under, today, the latest number is under where we thought it would be back in April. That's obviously encouraging. But the big question there is this going to carry forward to the period when the second round effects from the energy price was coming through? But Claire, did you want to?
Yeah, I mean, what I would add to that is, as you say, we've learned quite a lot since the last time we were sat here doing a press conference, and you can see how that has evolved in through the scenarios that we've done, where we've learned, if you sort of cast your mind back to then, it was unclear how long this would go on for. There were worlds in which actually this could escalate through energy prices quite quickly, but also end quite quickly. Sadly, we've not seen that resolution. We've learned that this could go on for a lot longer. We've also learned that some of those very extreme energy prices that felt possible then haven't come to pass and are unlikely to come to pass, which is why we've adjusted the scenarios to reflect that learning over the last 3 months.
And just to build on what Claire says and Andrew says in terms of the learning, I think the adverse scenario we've got is, if you like, a continuation of this episodic nature of the conflict, which gives you more persistent, higher energy prices, and the learning, I would argue, and we use this language, I think means that upside scenario, that adverse scenario, is a plausible possible future. Equally, we've had more evidence, as both Claire and Andrew were saying, on the underlying disinflation process continuing, and were the balance of risks to change, and Andrew's been very clear, I think we've been very clear on that we see the balance of risks on inflation tilted to the upside, and that's coming from global factors. Were that to change, then you've got more chance of the milder scenario playing out, but that's not where we think the balance of risks is at present.
Faisal and then Tom.
Thanks, Governor. Faisal on BBC News. So, I mean, just to clarify, I think you did say this in terms that if the conflict persists at the current clip, essentially a rate rise is on the cards. But if the sorts of de-escalation that sort of tentatively appeared about a month ago, if that persists, then you could even cut. I mean, it does seem so dependent now on what happens geopolitically, well beyond even your powers, Governor. And then secondly, are you surprised by the resilience of the UK economy? You know, there's a little bit of a bump up in growth, and there's been some more positive numbers over the past couple of weeks.
Well, I think finally it's interesting when you said at the current level of the conflict, because you even look at the last week. We had a period last week where it looked like there was some settlement and some was a reduction in activity, and then it's come back again. So I think when we talk about the current level, that's obviously a slightly hazardous comment. So there is huge uncertainty there, and as you rightly say, that is very important. Just to reiterate, I think there are two lenses, if you like, here. One is that, and the other is then how it's reflected through into the UK economy. And this picture I think I described, where we are seeing the disinflation process continue. As I described, there's quite a lot of evidence that's coming our way that, for instance, margins are taking more of the cost pressure. But there's an awful lot of distance to travel on that story, and we need to see how it evolves.
Tom, right.
Tom Rees from Bloomberg News. Claire, of the people who vote to hold rates today, I thought you sounded the most cautious. Was it a close call over whether to hold our hike today? And, how much longer do you feel that you can wait before acting on rates?
Sure, it wasn't a close judgment for me. I think it's pretty clear, and I was pretty clear that holding rates at their current level was the right thing to do. I think basically you've got these sort of two opposing factors. We have had more evidence on disinflation. I've sort of learned quite a lot about the security of that disinflation process prior to the war, but obviously there are a range of other things that have factored in. The conflict itself obviously raising inflationary pressures, other risks around that. So you've got these two effects happening at the moment. We have got some restriction in the economy now. I think the thing that the thing that we are watching, the thing that matters is actually what will this do for second round effects? How will these increases in inflation through to the direct and indirect effects that we know are coming? We know inflation is going to go up later this year. We certainly expect it to because of the indirect effects. It's how that plays through into wider inflationary pressures, and it's that assessment of a whole range of data, and we've set out a lot of the things that we're looking at and monitoring, and it's about those pieces of data and how they all interact with each other that will form the judgment on where rates need to go.
Go ahead, Tim.
Thanks. Tim Wallace at the Daily Telegraph. Governor, can you expand on the risks to the outlook for food prices, please? So there's the wildfires going on, the NPR mentions El Nino and some of the disruptions from the Middle East. What are you looking at when it comes to the impact on food prices, living costs, the wider economy and monetary policy from those factors?
Well, first thing to say is that the information we've received in this round on the likely increase in food prices through the rest of this year would indicate that it'll be lower than we thought it would be. And that's a mixture of information we get from our agents, information we get from surveys, and obviously that's encouraging. So let's start there, as it were. Now, you're right to say that there are quite a few risks around it. I think you probably named most of them, but I'll say a little bit more. So first, obviously, there is the effect of the pass-through of energy prices themselves. I think one of the things that I was struck by 4 years ago was, just the size of the energy content in processed food costs. It is probably larger than many people, I'll put my hand up here, would predict it to be if you were asked to guess it without knowing the answer to the question. So that's obviously highly relevant. Then, as you said, we don't for a moment pretend to be experts on this subject, but we can observe the reporting that there is a build-up of what looks to be a large El Nino system in the Pacific Ocean off the coast of Latin America. And we know from past experience that does have effects on the world climate to come. So we'll have to watch that one very carefully. I won't put it more than that, I think, at this stage, because it's obviously A, uncertain, and B, it's not our area of expertise. So that, yeah, there are a number of issues at play here in terms of risks.
And just to build on that, one thing we've also emphasised is how these shocks could interact. El Nino plus, were there problems with supply chains, perhaps linked to a re-escalation of the conflict? We flag in box E how because of El Nino there were challenges with getting through the Panama Canal, and again, as Andrew says, we're not experts in these in supply chains or in climate, but we do think that these could have consequences for global prices, which is why we see the risks tilted to the upside on inflation relative to our central projection.
Straight in the middle here. And then Philip.
Isha Nasser, New York Times. So you've talked about this underlying disinflation still continuing in the background and assuming, relatively soon resolution to the conflict, that may be returning as the dominant factor. But just in terms of economic activity, can you just kind of talk about what you see as being the underlying trend there, whether an end to the conflict could see that speeding up, or is that weakness in demand continuing? And then I'm not going to ask you to comment on what Kevin Walsh has said yesterday, but I do wonder if you feel that the refusal to give any forward guidance leads to volatility in treasury markets that then can impact the gilt market, if you have any sense of that spilling over more globally.
Well, I'll do the second bit, and then I think Claire will come in on your first question. I mean, look, I think if you look at the gilt markets, you look at government bond markets generally, I think over recent months, by far, of course, the biggest influence on volatility in gilt markets has been the fluctuating events in the Middle East. There's no question that that's the biggest and dominant cause of fluctuations. I mean, we've obviously followed it very closely, and you can see it. I mean, you can see it very much in real time.
Yeah, on activity, I mean, look, activity at the moment is, we judge it to be relatively weak. So it was about 0.1% growth in the last quarter. That's obviously below what we would expect supply to be. So you've got weakness there. I mean, we do, in our central projection, and as Andrew said, I wouldn't put, too much weight on it, but we do have that weakening slightly, and we've been expecting that for some time. I mean, as we've heard, the economy has proved more resilient and in lots of expectations formed, and actually we've more recently had some positive data around consumer confidence, retail sales, the PMI, most recent PMIs, those sorts of things. So, we are obviously keeping an eye on activity. It has proved to be a bit more resilient than we might have expected, but underlying the trend is one of relative weakness.
Philip. And then Delphine.
Hi, Philip Inman from The Guardian. One of the frustrating aspects of this press conference is we don't have any of the people who voted for a rate rise on the panel. Given that, could you explain a bit more about why you think they would believe that it's almost baked in that there are second round effects coming, and that's why they voted for a rate rise?
Well, you've got their paragraphs. One of the things that we've obviously changed in recent times is to introduce these individual paragraphs, so you can see their views set out there. If I can speak for them for a moment, I think you'll see a difference of view in terms of concerns about the second round effects. You can put different weightings on these scenarios, as we said. Claire just said it again, quite rightly. Frankly, we are all of us less sure about the weightings to put on these scenarios because of the volatility in the Gulf, particularly, than we would, I think, normally be when we have scenarios in front of us. So that's very fair. And then I think, to speak for my colleagues, I think there are some differences of view around whether, given all of that, and if given the sort of the distribution of risks, whether it's better to act sooner or to see how this evolves. And that's reasonable. Reasonable people can disagree. That's a sort of monetary strategy point, really. I think we are in my view, as you'll see, it's been set out, I think we are in a position where we can sensibly wait to see how this evolves, but I absolutely respect colleagues who take a different view on that.
Can I just add something? And just on your point, Philip, because I mean these press conferences are always about the decision, and you know, we, as you know, almost every decision at the moment there's a split vote. That the press conference is about the decision we've made today, and as Andrew says, the paragraphs set out in quite a lot of detail the range of views. But I think it's very important that the focus here is on the decision.
Delphine.
Thanks. You've flagged up that it will take quite some time before second-round effects can be observed, although they're the crucial part. Would you wait to make any move until you're able to observe those, or would you potentially react on the back of movements in energy prices before we get to see those wage settlements coming through?
Well, my own view on that is I think, to sort of develop your point, that second round effects emerge over quite a long period of time, because obviously that's consistent with the transmission mechanism of monetary policy that we've explained, you know, and written quite a lot about and spoken quite a lot about. So I think, look, I'd only go so far as to say that I don't think it would be wise to wait for all of the second round effects to emerge, because I think in most situations, if not all, it would be too late by that stage. But that doesn't, I know, help with the sort of the underlying question you're asking, which is, so at what point would you therefore act? That's all very well to say you wouldn't wait till the end. I think we just have to judge that by the situation we're in. Okay.
And we have set out a monitoring framework in Box A to try and help frame this, to exactly deal with the challenges that Andrew's just flagged, and we've given our assessment as of now in I think Box B. So we're trying to be as transparent as we can about how these will feed back to inform our judgments and our decision.
But there's no single measure that will give you the single answer.
Ritika.
Ritika Gupta, CNBC. Governor, I wanted to get your thoughts around QT. I know that the final decision is coming in September, and you've given some analysis of the impact of the balance sheet runoff being modest. But I wanted to get your thoughts on the kind of conditions that would make you hesitant to continue with QT in the future.
Well, I can tell you one thing with absolute certainty: there'll be a decision in September, as there always is, and we will announce it, and it'll be transparent. And as we always say, you know, and we've laid them out again, there are the principles that we operate under, and market conditions obviously form an important part of that judgment. So we will, behave as we always do in that respect.
Patrick and then David.
Hi, Patrick Tour from the Daily Mail. Just a quick follow-up on that. Have you any plans to reduce the interest rate that you charge on banks' reserves held with you as a result of...
Well, the interest rate on reserves is a key anchor for the monetary transmission process, because, you know, when we announce a decision like the decision we announced today on bank rates, you can well ask, well, what does that mean? It means exactly that. It's the rate we charge on reserves of accounts that the banks have to hold at the Bank of England, and then that transmits out into the economy. So, you know, our absolute focus is that we need that rate to be aligned with the decision of the MPC to make that transmission process work. So that's a slightly longer way of saying no, that's not an issue that we've reflected on.
David and then Maurizio.
Thank you, David Milliken from Reuters. One thing I did want to sort of ask is sort of whether sort of what the Bank of England does in rates is affected at all by sort of what the Fed or the ECB does, whether it becomes harder for the Bank of England to sort of keep interest rates on hold if the Fed potentially raises rates, if the ECB continues to raise rates further. And just returning to this issue of sort of QT, I'm not expecting sort of the bank to sort of announce a decision today, but I did notice that sort of in the box you did have a slightly higher estimate of what you think the impact of QT on gilt yields has. And I just wanted to get a sense of whether that upward revision is the type of thing that has sort of much bearing on sort of a decision in September, or whether it's just a relatively small change, especially given that I think the bank's last survey of market participants shows sort of a lot of people in markets do expect the bank to slow the pace over the next 12 months?
Right, I'll take the first part. Dave may want to say something on the second part of your question. Well, all of us as central banks obviously set monetary policy for our own domestic economy and our own domestic inflation situation. Now, the UK is an open economy, so obviously we look at world conditions, and of course, never, in some ways, never more so at the moment, given what's going on in the wider world, and particularly the conflict in the Gulf. The world economy enters that way, but ultimately we all set the level of our official interest rate to match the situation in our domestic economy, and so we don't say what have the Fed done or what have the ECB done and what shall we do, but we are looking at obviously the state of the world economy, the state of the economy of our trading partners, and feeding that back through into the assessment system we have. Dave, do you want to?
Yeah, and just to recap on the analysis we published today in Box G, and I mean the story so far on QT, the stock of assets peaked at 895 billion in terms of the stock of assets for monetary policy purposes. That was right at the start of 2022. 4.5 years on, we're down at 491 billion, so that's a 400 billion fall. So that's the scale of QT over that period. 10-year gilt yields have risen by about 350 basis points, and we think about 200 basis points of that was driven by term premia. So that's your context, and then within that, our latest estimates are the impact of QT, which remember is over that period, is about 20 to 30 basis points. That's up from what we published last year of 15 to 25 basis points. But these are very small incremental increases against that backdrop, and suggest that QT is driving a very small fraction between 1/10 and 1/6 of that total change in term premia, which is, as Andrew was emphasising earlier, entirely consistent with our principles that bank rate is our primary tool and QT is operating in the background and is well understood.
Maurizio and then Anna.
Thank you. Maurizio Alencar from Citi. You've talked about the analysis there on how much QT has impacted gilt yields. With the new Prime Minister and new Chancellor coming in, how much of that premia is actually down to economic policy uncertainty? And just on a general note, what advice would you have to Burnham and Healey in managing the economy?
Well, on the first point, I think really, a week and a half, the measurement exercise that we did and that Dave's been talking about runs a lot longer than that. In fact, actually, it terminated before that point. So please do not try to, in any sense, derive any sort of assessment of the change of government out of that calculation, because it's just not there. I think, look, as far as any advice I would give, if you don't mind, that's obviously advice that the Chancellor and I talk regularly, and I think there is a role for us having those conversations. And yeah, I think advice might be a slight overstatement, but we do exchange views regularly. Have done with quite a lot of chancellors now, and I very much look forward to working with the new chancellor. We've already had conversation, and that's good.
Anna.
Thank you. Anna Wise from Press Association. You've talked about businesses more likely to absorb pressure from the Middle East into their margins. What consequences do you think this will have on the business environment, and do you expect more businesses to collapse as a result?
Well, look, this is a challenging cost pressure for businesses to absorb, and to some extent pass on. It's quite. We take some comfort from what we've seen from an inflation perspective in terms of, if you look at, for example, some of those surveys about own price expectations, those haven't gone up as much as you might expect, our analysis might have expected. So that's where we're getting this suggestion that there's going to be this squeeze in profit margins. Look, it's another cost to businesses at a quite difficult and challenging time. I spoke earlier about some of the weakness on the activity side and in demand. So, that will add to that. I mean, as I say, we have seen more resilience than could have been expected, and some of the more recent data has been quite positive. But, we're keeping a sort of eye on that. It's a challenging environment out there for businesses, and, we recognise that. We hear about it a lot through our agency network. We're out and about talking to businesses around the country all of the time, so we've got a good sense of how they're feeling and what are the things driving their costs, and insofar as they're able, what they're expecting to do with pricing.
I suppose the other thing, this is a fully dynamic story, so you would imagine that if, as we're describing, businesses are finding it difficult to pass costs on into prices, of course that will cause them to re-examine their costs.
Josiah and then Lucy.
Yeah, Shepard Bobby to Central Banking. So, Governor, my question is around the BOV's new communication strategy and the risks around second round effects. So, we saw today that MPC is edging towards a hike. You yourself highlighted how much searches have increased, around inflation on the internet, and also that wages in parts of the economy have been falling. So, communication is particularly important at this time. And so my question is, could sharing each MPC member's views as well as multiple scenarios be adding to uncertainty and the risk of second round wage effects, particularly among members of the public who aren't finance professionals?
Well, can I first of all say, please do not leave this room thinking that the Bank of England is edging towards a hike, because frankly there's nothing in what I said, and I think any of us have said along those lines. We took a decision today to leave bank rate unchanged, and that is the relevant conclusion. This whole transparency question is really interesting. I mean, going back to Marine's question at the beginning, you might say, well, obviously there's some. I'm not going to comment on the Federal Reserve, except to say, obviously, there's a lot of commentary on sort of, in a sense, the communication has in a sense become quite limited in some sense. That point is being made. I'm not going to make that conclusion. I just observe that it is being made. Now, you're making the reverse point that we've actually expanded communication. We've got the paragraphs, we've got scenarios, and that was, by the way, very much obviously in response to the report that Ben Bernanke did, because that was very helpful to us in thinking about it. I think the point on which I agree with you on is that, of course, it's not just communication for the sake of saying things. It's got to convey, meaningful messages. Now, those come from the, combination of having a collective message. You get that, obviously, with us through the monetary policy statement, and that is the view of the majority. Let's be very clear on that. But I think it's helpful then to be able to see the range of views, and I hope the paragraphs that each of us write help with that. That's what they're intended to do, to give people a sense as how the range of views is formed.
Lucy and Jack. Oh, she's right in the middle there.
Thank you. Lucy Lequier with AFP. You previously warned the new Prime Minister of the current low growth in the economy, stating that it should be in his top priorities. Given that you don't have a dual mandate, how do you intend to navigate this equilibrium between raising rates to help him combat inflation and the effect that it could have, negative effect it could have on the economy?
Well, I made sorry, I don't want to use this question to advertise my speeches, but if you don't mind for a few seconds, I made a speech at the Central Bank of Iceland, actually, when was it? Late May, mid-late May, on this very point, actually, and I said, look, we don't have a dual mandate, but we do in our mandate have what we tend to call for short trade-off language. In other words, when we face a situation, as we do at the moment, where there is in a sense, a tension between a negative supply shock, which is pushing prices up and pushing activity down, our mandate remains the same. It's obviously the inflation target, and that's very important. But the language in the remit, the so-called trade-off language in the remit, gives us some flexibility about how quickly we return inflation to target, and that judgment is made according to the structure of our remit. It's a hierarchical remit, like the ECB's remit, actually. And the second part of the hierarchy is around growth and employment. So the point I made in Iceland is, yes, we do consider that in the current environment. that is a sensible thing to consider. It's our job to return inflation to target. We have got choices over how quickly we do it, and I think it's sensible to exercise those choices with the trade-off in mind.
Jack, and then Han.
Thanks. Jack Barnett from The Times. Sorry, Governor, I'm going to try and draw you into fiscal policy again.
Well, you can try. Can't stop you doing that.
Also, potentially one with your FPC hat on. There's been some talk about the new administration potentially looking at the bank levy or some sort of bank tax, maybe changing the regime. Would you caution Andy Burnham and his Chancellor against looking at the bank levy again? It's had a lot of criticism.
I'm not going to really get into that because I've had no conversations. I've had a conversation with the Chancellor. We haven't had any conversation about policy because, frankly, a week and a half is a short time. May not be in politics, but it is in economic policy. And so I think it's entirely appropriate that a government has a chance to think through its own approach to policy, to think things through. I would be very happy to talk to them as and when, and that's the right way to do it.
Hannah at the back.
Thank you. Hannah Brenton from Politico. Coming back to the geopolitics, you said, the UK is an open economy and you have to look at world conditions. But could you perhaps expand on, do you think the UK is more exposed to the kind of on-again, off-again nature of the Middle East conflict and the effect on energy prices than other economies?
Well, as I say, the UK is historically a very open economy, so we are more exposed to events in the rest of the world. We've set quite a few of those out in the report because there are quite a few things going on. Now, that doesn't obviously necessarily mechanically give you the answer on energy prices, but what it does tell you is, yes, we do have to spend probably relatively more time as an open economy examining the impact of the world on the UK.
Harrison, and then Electra.
Harrison Moore, Market News. So in the minutes it's noted that the dissenting members referenced research that found that setting policy as if there are stronger second round effects and then course correcting would be less costly than the converse.
Yes.
What is your take on this? And I know you've already said that you would view at the potential evidence of second round effects at the time, but do you have a sense of how confident you need to feel about whether they're materialising?
Yeah, this is a point I think when the previous question asked me to have to sort of in a sense put myself in the sort of position of the minority and describe their decision. I mentioned this point, which is what I call the monetary strategy point. But I think though just the way you framed the question was actually quite right, which is you did make the point if the second round effects were stronger, then this strategy question comes into play, that is the better course of action to take out sort of insurance, if you like, preemptive insurance or not. And so if, as I said, there are different views on the question of second round effects at the moment. I think some of my colleagues, I don't think the evidence points to stronger second round effects, but I think they think there will be, stronger second round effects. Speaking for myself, I think we should take something from the fact that we've seen weaker pass-through in recent times. And going back to this point, we are actually in the latest CPI numbers somewhat under where we were expecting to be, and that under point reflects underlying inflation. It's actually in this area of the sort of persistence and second round effects. So, I'm not in that place of saying, there are stronger second round effects. I'm not in that place at the moment of saying I think there will be stronger second round effects. My jury is out, as it were, but I would say that we go into the position with having shown rather less in terms of second round effects. And this point Claire made earlier as well.
Electra.
Electra Ardicino from the Financial Times. On QT and the balance sheet, are you still of the view that the Bank of England requires an indemnity from government over future asset purchases? Thank you.
Yes, this goes obviously way down into the minutiae of our balance sheet and our history. There really is an important difference between our position and other central banks, and it really reflects this, that our balance sheet is split into two parts by the 1844 Bank Charter Act. So we have what's called the banking department and the issue department, and the only thing, the issue department is the note issue, and the income of the issue department is the seigniorage, which is the profits from the note issue. And obviously the seigniorage is actually quite considerable. Give or take, it's around £4 billion a year. Now, other central banks have they just have a consolidated balance sheet. Now, what that enables them to do is that enables them to do one thing, and then another thing enables them to do another thing. So obviously, that they can use the seigniorage more, in a sense, as a buffer, an income buffer. They've also tended, some of them anyway, have adopted accounting standards which allows them to book a deferred negative asset. In other words, say, that's in a sense anticipating future seigniorage income. We don't have that ability because of the way in which the 1844 Act governs our balance sheet. So it's now look. I mean, it's been pointed out by the people. Actually, our balance sheet our situation is more transparent, but it does therefore, to your question, underline why we do need the indemnity.
Francine, as long as you don't ask a question about seigniorage, and then.
Well, I think Dave would love to answer that. Or Andrew.
Francine, Bloomberg TV. How much, Governor, does the uncertainty over the budget in the fall impact your thinking on the insurance hike?
Oh, I like the way you slipped the insurance hike in again. I'll just remind the answer I gave to the previous question that I'll borrow the phrase of Alan Greenspan, the late Alan Greenspan. If you come out of this session thinking that we've talked about an insurance hike, you've obviously, I'm afraid, not understood what we've said. But no, look, on the budget, no, it doesn't. We will approach this budget like every other budget we approach. We condition our view on announced government policies. When the budget is done, we will therefore do just that.
Is it Emma there? Yeah.
Emma Taggart, The Telegraph. Just jumping back to the change of government this month, one topic that's come up is the UK tax burden, which is heading towards a record high. In your view, what would the impact be if this were to rise further?
Well, again, look, I think it's important that any government has space to consider what it wants to do about the situations that it finds itself in. I don't think it's helpful if people like me go around influencing the shape of that space in any way whatsoever, so I'm really not going to comment on that.
Delphine and then Faisal.
Thanks. It was a question on the global inflationary environment. So on these forecasts, UK inflation will be running above target for 7 years, I think, before it comes back below 2%. And you're pointing to two other, and that's obviously due to these series of exceptional global shocks we've had. You're now pointing to another potential two exceptional global shocks in the form of AI supply chains and El Nino. So at what point does one have to see this global environment as normal?
Well, first of all, I mean, El Nino, as I said earlier, I think it's something we have to watch carefully to see how it plays out, how it shapes up. On the AI point, I would simply say that, yes, it is an issue. I mean, I get asked quite often what the inflationary impact of AI is going to be, and I say, well, it depends. Because AI will, most likely have productivity benefits, but it may have cost implications as well, and it depends on the sequencing of those things. But let me make one further point before I come in. I mean, we are also seeing some downward pressure on goods prices at the moment. That may be reflecting, the impact of tariffs and the fact that there is trade redirection going on. But that's one to put in the pot as it's going in the other direction.
Yeah. I mean, look, you're right in that we've had a long period now with a series of, each individually could be seen as quite an extraordinary shock, but actually, as you say, sort of 7 years of this, or depending on how you measure it, it's been going on for some time. I mean, that is why we have changed the framework by which we're thinking about and communicating monetary policy to be one that is much less anchored around a single view of the economy with a particular view of both the demand and in particular supply. It allows us to think a bit more about some of these structural shocks, some of these supply side shocks. So it's one of the reasons that we're keen to use this framework in which you're thinking about other scenarios for the economy because of the sorts of shocks that you're facing. There's just a lot more uncertainty around there. I mean, I would, Andrew's right, we've highlighted, in a sense, 3 sort of trends, shocks, pressures in the global economy in that box. They do move in opposite directions. You've got the potential sort of trade redirection. We've got, evidence and analysis that shows actually that is pushing down on UK inflation now, we think. The AI question is a really interesting one, and you can see it not just actually in the global box that we've done, but also in the agents analysis that show actually for companies in the UK, they are telling us that they are seeing increased costs because of AI now. It's a really interesting question. How AI will transmit through the economy is obviously highly uncertain. There'll be a cost element, and we're beginning to see that now play through globally and domestically. But of course, there will also be the impact on productivity, the impact on labour markets, and there's a whole range of scenarios there about how this may play out. We do expect, and you can see it in things like the DMP results that we're getting, is firms are seeing an increase in productivity and are expecting an increase in productivity. So that over time will change that balance. But whether, as Andrew says, these happen, it may be that you see the cost before you necessarily see the supply benefits. What we do know is there's going to be quite a lot of sort of transition and reallocation. And we've talked about the El Nino as well. And I would broaden that out and just think actually in general there's lots of risks to food and other commodity prices out there in the global environment. We have to factor all that in, and it is something that we've always looked at, but we're increasingly putting analysis onto that and thinking about how those things may differ, and what that might mean for our inflation paths.
Liza.
Thanks, Governor. The new Prime Minister, first measure was obviously to cut VAT on electricity bills. So that, you agree, I think, does have an impact on the inflation number. Yeah. So part of a pattern we've seen with their predecessor of almost trying to manage the inflation number through policy. How much does the bank, now you've seen a few of these types of policies, does that count as a sort of real reduction in inflation? Do you consider this to be a slightly different quality of inflation reduction that requires a slightly different response from a central bank? Because it seems to be quite a novel development that is now continuing.
Well, let me say 2 things. We obviously put it through the forecast machinery, but obviously we have to take into account how long it lasts for. It's not a permanent policy. The other point I make is I think quite rightly government describes this as a cost of living measure. And I would distinguish that. Yes, it has an effect on inflation, but it's not the government doing monetary policy for us. I mean, a cost of living measure is designed particularly to benefit the low-income households, and that's very much the right thing. That's a government responsibility, and I think it's important to distinguish that from our responsibilities, in fact, of inflation. We take it into account, as we should do, and we do.
Henry, last question.
Thank you. Henry Saker-Clark at Press Association. I just want to ask about consumer spending. You've mentioned there's some resilience, but some of the survey data has also pointed towards, I guess, some sort of fragility. You pointed to supermarkets flagging fragile consumer sentiment. Also in the service figures as well, there's been some weakness. Is there a concern there that we're about to see some sort of issues facing consumers, and how does that play into your considerations?
Claire.
Yeah, sure. I mean, look, we monitor this very carefully, and we look at household balance sheets, and over time. I mean, you're right. We see mixed data, and there's a lot going on, in the data, and lots of sort of temporary factors as well as some permanent ones. We monitor this data on how households are doing. On average, the picture is one that wouldn't mean that you expect to see a sharp deterioration, but we're also very conscious that there are a set of households at the lower end of the distribution that are very stretched at the moment. But we're not anticipating a sort of immediate fall off in consumer demand. As I say, we've got a slight weakening in the economic activity data in our central projection. These things are very uncertain, but that's our outlook.
Great, thanks very much, everyone.
Can I just say a couple of things? First of all, thank Bloomberg for hosting us while our our facility is being refurbished. I really hope that when our facility is refurbished, we can hear the questions there as well as we can here, because it's a joy to actually do these press conferences when we can actually hear what you're asking. The second thing I wanted, Nicola Heathman, who organises all of this, and for years has been shepherding this around, and is retiring today. And Nicola actually has been in the bank even longer than I have. She joined in 1983, so I'm a real newcomer joining in 1985. But I just want to put on record our thanks to Nicola for everything she's done to make these press conferences run as smoothly as they do. Thanks.
Thanks, everyone.